in all of my workshops, I talk about a story about a couple that I met with a number of years ago, and we'll just call them John and Jane. And uh, Jane retired a couple years before I met her, and she had been a good saver. She had probably saved about $400,000 in her 401k, and didn't make that much money throughout her working career, but had always consistently put money away and made that a focus. Well, she did not like her company. She did not like the company that she worked for. And as soon as she left, she wanted to take all that money out of her company's hands and put it into her own. So the year that she retired, she took all $400,000. She took it out of her 401k and she put it directly into her bank account. Not into another 401k, not into an IRA, but to her bank account. And if you're cringing, you got a good reason for it. So what she did, and at that time, the highest federal tax bracket was about 39.6%. And she had worked most of the year anyway, her and John. And so what happened in that scenario was that, she went from being at a 10 to 15 at that time, 15% federal tax bracket. And paying a little bit of money. And when she was putting money into the 401k, she was getting a tax break of 10 to 15%. When she took that money out, she paid, on some level, the highest federal tax rate at that point, which is 39.6%, and the highest Connecticut tax rate, because she lived in Connecticut, which was right around 7%. So she paid at that point over 45% in taxes to take that money out. Now, if she had just taken it out little by little over the course of her lifetime, she might have been just in the 10 to 15% tax bracket, probably just the 10% tax bracket. But because she took that all out at once, she gave up over 45% of her money in one foul swoop. And that really did have an impact on how they were able to live and be comfortable in retirement. So that is one thing that I certainly want to help everybody avoid. And I told that story at a workshop at the end of 2019. And as I'm walking out the door, and that was when you could still talk to people and shake hands, but as I'm walking out the door, a couple came up to me and says, Ben, I did the exact same thing. I made the same mistake. It wasn't $400,000, it was $100,000, but I did it, and I don't know what to do. And for her, that had only happened 2 weeks prior. So we got really lucky. There's a rule called the 60-day rollover rule. Well, we were able to take that money and we were able to put that back into an IRA. So that avoided her paying taxes on all of it that year. And because of that, she was able to take her, at that point, she was at the 22% tax bracket. We were able to make it so that she was only paying 10% federal taxes because we were going to give that to them a little bit over time. So when it comes to federal taxes, there's not a lot of things that I can guarantee, but if, we take out money in 1 year versus the next, and all of a sudden we're able to save 12%, I think that we did the right thing. So we really want to pay attention to how you're taking that money, when you're taking that money, when is it going to be best suited for you to do that, and how can we put you in the best situation to save as much money from taxes as we can. If you'd like to talk more about this, click the link below so we can set up a time to have a conversation.